it should be possible that the financial statement of an entity can be compared from one period to the other, or from one entity to a different entity. This means that the accounting treatment for a particular transaction or other event or condition must be the same from one entity to the other. This is why the standard or the IAS board restricts management or entities in using their own judgment to treat, these transactions or the same transactions differently from one entity to the other. When that happens, there will be issue with comparability, there will be issue with reliability, and there will be issue with relevance if those don't meet the one that is prescribed in the IFRS or IASB framework. In view of this, there is a standard that governs how an entity is supposed to select a new standard or a new policy, or also change the policy if there is a new one, or even use its judgment in treating a particular transaction or event or a condition, and also how to effect errors when they do occur in the financial statement. And this standard is the National Accounting Standard 8, Accounting Policies, Changes in Accounting Estimate, and Errors. And in today's lesson, that is what we are going to extensively look at. We will look at everything that you need to know under the standard, and we will also solve questions to establish our understanding. So let's look at the objective of the International Accounting Standard 8. The objective is to prescribe the criteria for selecting and changing accounting policies, coupled with the accounting treatment for changes in accounting policy, changes in accounting estimate, and errors, and also to provide financial statements that provide information that is relevant, that is reliable, and that is having the qualitative characteristics of comparability. That is the objective of IAS 8, is to make sure that there is a criteria for selecting a particular policy, and then if there is a need for you to change it, this criteria should govern you or should provide a means of guidelines in changing those policies. And this also works for estimates as well as prior period errors, how to correct them. There is a guideline for that. Again, a scope applied to the selection and application of changes in accounting estimates, changes in accounting policy, and then how to correct the prior period errors. That is basically the scope. So it applies to anything or anything that pertains to changes in what? A policy. Very soon we look at the definition, or we establish a definition of policy and what's an estimate, as well as what is an error. So we are basically looking at the scope, which says that it applies, the standard applied to the selection and application of how to account for changes in accounting estimate, and as well as how to select the accounting policy, as well as the estimate and the errors. So now let's look at the definition of the terms we are going to meet in our discussion. When we talk about policy, we are saying that policy is a specific principle, it is a specific basis, it is a specific conventions, specific rule and practices that an entity applied in preparing and presenting its financial statement. So anytime an entity applied a specific principle, rules, basis, conventions, and practices in preparing and presenting its financial statement, then we say that particular event is called policy. When we talk about estimate is about changes that is made to, or adjustment that is made to the carrying amount of asset and liability. We say something is an estimate if that thing cannot be measured with a precision, or it comes with a level of what? An uncertainty. Then we say it is what is an estimate. So for instance, you cannot measure depreciation with a level of certainty. It comes with what? Some form of what? Subjective. It's subjective in nature. It's uncertainty in nature. It's just something that they just say that, oh, we should measure it this way. It doesn't come with any facts. Then we say that thing is what is an estimate. Errors, on the other hand, are the omissions from or misstatement in the financial statement. Although there is a relevant or a reliable information available for them to prepare the financial statement form, but there is an omission or misstatement before the authorization or the financial statement is issued out. Anytime something happens and we say there is an error. So basically we look at errors to be omissions, or some of them are mistakes, it's not consciously incurred, or some of them to are fraudulent activities on the part of the accountant or the management of the entity. So these are the definition of the terms we will be looking at in our discussion. Now I'm going to structure this particular lesson into steps so that we can really get a clear concept of the standard. So first we will look at the selection of policy, and then we will look at how to account for changes in the policy, and even what warrants, what to show that there's a change in policy. And then we will establish the difference between a policy and estimate. Then we will look at what is the change in estimate and how to account for it. And then we look at errors and how to account for the errors as well. So in this case, let's start from the selection of a policy. At any given point in time, if an entity wants to apply a specific policy on some transaction or other events or conditions, then the entity must first find out if there is an accounting standard that prescribes its treatment for that transaction. So for instance, we have an item like an inventory. Then quickly we want to know how to value the inventory. Then we have to apply the standard IAS 2. Assuming that there is an item that have in its form an intangible asset like a brand, and you want to account for this brand or patent, then quickly you have to run to IAS 38. So this means that anytime a particular transaction is already having an accounting standard, then if you want to account for such a transaction or such an item, then you have to apply that standard. Remember that the most important thing is that you should make sure that the information you are providing is relevant and it is what? It is reliable. However, if there is no accounting standard to govern a specific transaction or other event or a condition, then it is required that the management will use its judgment in accounting for that particular transaction. But in doing that, because we want to ensure comparability, in doing that, the standard prescribes some guidelines for you to use when the entity is using its judgment or management is using its judgment to treat a particular standard. The first guideline is that first, look at the requirement and guidance in IFRS with a similar transaction. Let's say the transaction you want to account for is already having established standard. So you look at how they account for that similar item. The second one is that you should always make sure that the item or the transaction you are accounting for meet the definition or follow the definition, the recognition, and the measurement of asset and liability income and expenses as well as equity as enshrined in the framework. So at any given point in time, you should make sure that you follow these two requirements or these two guidance when there is no policy or there is no standard for the treatment of a particular item or transaction or other conditions or other events. Again, it is important to know that anytime you are using your judgment, the entity is using its judgment, it is important that the financial statement that is being provided provides an information that is relevant to the decision-making needs of users. Again, the information or the financial statement should provide an information that is reliable so that the financial statement will be faithfully represent the financial position, the financial performance, and then the cash flow of the entity. Again, the financial statement should reflect the economic substance of the transactions, other event or condition, not just its legal form. Also, that financial statement must be neutral. That means it must be free from any bias, it must be prudent, and it must be complete in all material respects. This is why it is very important that anytime the management is using its own judgment, you have to make sure that you follow all these judiciously. This is why it is very, very difficult to produce any financial statement that does not meet the accounting standard, unless, of course, the entity or the management want to do so at their own risk. There are so many restrictions to make sure that anytime a financial statement is produced, it meets the requirement of the International Financial Standard Board or the IAS, the board framework. So having understood the selection of the policy, now we want to look at change in accounting policy and how to account for them. So what we looked at previously was the selection, how to select an accounting policy. So here we want to look at the change in accounting policy. It is very, very important that at any point in time, there should be nothing like change. It shouldn't be even mentioned at all, like there's a change in accounting policy, that the entity will just stand up and say that, oh, there's a change in accounting, or the entity's judgment want to change an accounting policy. There is nothing like that. Because of what? There should be a level of consistency from one period treatment to the next period treatment, from one entity to the other should be the same. But there is a change in accounting policy when and only when it is required by an IFRS. So we only say there's a change in accounting policy if it is required by IFRS. For instance, previously the borrowing cost was not capitalized as an asset. It was rather expense in the P&L account as an expense. But now borrowing cost, which is IAS 23, capitalizes borrowing cost as part of the cost of an asset. That means it's a part of the asset which is treated in the statement of financial position. Such was required by the standard, so therefore it's a change in policy. Again, a change in policy should only be possible if that change in policy will provide a financial statement that will provide an information that is reliable and more relevant. So if this change is going to provide a reliable and more relevant financial statement information, then we can go ahead with a change in policy. Sometimes it is very obvious that there's a change in a policy, and this change in a policy or this standard comes with transitional provisions. That means how you should apply it or how you should account for the change in policy. But sometimes some change in policy does not show if even that was a change in policy. So to make sure that there is a change in policy, three categories of terms can aid you to know that there is a change in policy or there is no change in policy. And the first one is we are looking at recognition. We are looking at presentation, and we are looking at measurement. If any of these three things happen in a particular standard or a policy, here I'm using policy or standard because they are synonymous to each other. If any of these things happen, then we are saying that there is a change in what? In an accounting policy. So what do we mean by recognition? Maybe previously an item was recognized as a loss or as a profit or as a P&L item, but now it's supposed to be recognized as an asset. The example I gave earlier on, that the borrowing cost. So previously, borrowing cost was the interest on the borrowing cost was taken to the P&L account as an expense, but currently we treat borrowing cost as part of the cost of the asset. Presentation. Maybe previously the depreciation was added to the administrative expenses, but now depreciation is supposed to be added to the cost of sale, unless of course there's some apportionment or allocation basis given in the question. So that is about presentation. Measurement. Previously we used to use historical cost in measuring our asset, but now if you want to use replacement cost or any other forms of measurement, then we say that anytime any of this happens, we say that there's a change in accounting policy. So this should probably aid you in your exam situation if you want to verify that there's a change in a policy or there is no change in a policy. First find out if there was a change in recognition, if there was a change in presentation, or if there was a change in measurement. Having understood how to show that there's a change in a policy, now let's look at how to account for change in a policy. How do we account for it? Accounting treatment for a change in a policy. Now, anytime there's a change in a policy, then it must be treated retrospectively. And what do we mean by treating a change in a policy retrospectively? This is where we apply the new policy to a transaction or other event or conditions as though this policy had always been applied to that particular transaction. So it's just about applying the new policy as if it has always been been used. So here, let's say we are in 2022 now, and then we used to treat an item here in 2016, and then this item has changed here. Now let's say this was cost to us previously, but now it's supposed to be treated as an asset in 2022. What it means is that we have to go back to this 2016, the earliest period, the beginning of the earliest period, and adjust all the retained earnings and all the comparative figures of the entity to reflect that this new policy in 2022 was as if it was applied from 2016 up to 2022. That is retrospective treatment. So anytime there's a change in policy, it must be accounted for retrospectively. So do not forget. To properly understand this concept, let's use the question to establish our understanding. Remember that the question link will be in the video description, so you can get access to it, so that you can follow the solution. Okay, so the company says Multi Limited. So we are looking at Multi Limited, commenced trading 2 years ago. So on 1st January 2006. So let's take date into consideration. So they started business on 1st January 2006. Yeah, 2006. And adopted the accounting policy that then allowed by IAS 23 borrowing cost of recognizing all interest costs in profit and loss. So at this particular day that they started business, borrowing cost was treated in the P&L account as a cost, or in other words, as an interest. So it was treated in the P&L account as a cost, as at this date. Now, we were told, we were given the financial statement for the 2 years for 2006 and then 2007. We were given the property, plant and equipment figure for the both years. We were given the other assets. The question will be in the link, so you have access to it. We are given the share capital to be 100. We have retained earnings for the year ended 2006. The retained earning for the year ended 2006 becomes the opening in 2007. and then we have the year ended for 2007 as well, and we have their liabilities. Now, in each of these years, borrowing costs attributable to the qualifying asset of 10 million have been recognized in profit and loss. So in these 2 years, there was a borrowing cost of 10 million recognized here, and then 10 million recognized here as well in these 2 periods. But these were recognized as an interest in the P&L account, but there is a change in the policy. So there is a need for corrections, or there is a need for retrospective treatment. Now let's look at what the statement is saying. The revised IAS 23 requires borrowing costs attributable to a qualifying asset to be recognized as part of the cost of these assets. And then Multi Limited has adopted this new standard, early and designated 1st January 2006 at the date on which it commenced trading, at the date on which the new standard should apply. So this day that they started business, they said that the new policy, which is the now happening at the end of 2007, should be started to be applied over here. So mostly the question will tell you their comparative year, or the year for which you should start the retrospective treatment. Now, before I forget, there are sometimes retrospective treatment will not be practical, or not be practicable. It will be impractical because you don't have information to apply the changes in the policy retrospectively. Anytime it's like that, then it is the standard allows that you should apply the changes in the policy prospectively from the day that the changes has occurred into the future. Sometimes you may not know the specific effect, neither can you determine the cumulative effect, and therefore you have to it is impractical to use retrospective treatment for the change in the policy. Therefore, the standard allows, IAS 8 allows that you use prospective treatment, that is from the day that the policy becomes possible that it is being changed into the future periods. Now let's come to the question. Now, how do we apply this effect? How do we apply this effect? Now, the 10 million they said it is for each period. So 10 million of borrowing costs in this period, 10 million of borrowing costs in this period was incurred, and these figures were actually incurred as what? As a interest, or that is, it was a cost to the business. So now let's look at how you go about them. So first, so we are looking at Multi Limited company. So let's have 2007 over here, and then 2006. This is the second year. So we are looking at these 2 periods. So if it to be 3 years before these changes was done, then probably we have to also go add the last year in the question. Now also remember that first, let's check, is there a change in the presentation? Is there a change in the recognition? Is there a change in the measurement? Yes, there is a change, because now instead of the thing now classifying as what? As a cost, it's now going to be classified as what? Qualifying asset. That means it's going to form part of the cost of what? Qualifying assets. That means there's a presentation, and as well as there's a recognition, changes in there. So there is a change in what? Policy, and therefore we must what? Account for these retrospectively. Now let's bring the PPE figure. So remember that the values are in dollars and they are in million. Now, per the question, the PPE figure was 248 over here, 248 over here, and it was 241 over here. So per the question, the PPE figure was 248 over here, and then 241 over here. This is previously, that's what it was. That was what was done. Now let's check. Now this 10 million here was incurred in 2016, 2017. So we have to add them back. So here we have to add 10 million to 284, and then we also have to add 10 million to the 241. So this is going to give us now 251. But remember that the carried amount here will be carried forward to 2007. The question was like the borrowing cost was incurred both in 2016, 2006, and then 2007. It was incurred in these both years. So here we have to add, because it's now a qualifying asset and therefore must be added back to the PP. But remember that what you have added here is here, so it will be carried forward to what 2007. So when you come here, there's one more term we are supposed to add. So you have to add another one term. So this is going to give us 304. So this is the treatment. So we have gone back to add what was supposed to be treated as an expense. Now it is treated as what? As an asset in the books of what? Of the entity. So if you follow, we have other assets in the question. The other asset in the question was 899 and then 900 over here. So if you add them, you are going to get $1,203 and then 1151 dollars. So this is it for the asset part. Now we want to look at the share capital. So in the next, we have share capital, which was 100. It was also not affected in this question. And then we have profit at the end of year 2006. Okay, so here you were given retained earnings over here. So retained earnings in the question. Now retained earnings at year ended 2006 was 41 and 41. So this was the previous figure in the question. This is what we have in the question. Remember that this figure was treated as an expense, so it has reduced these values by 10. Therefore, you have to add them back. So there's a need to add this one back here. Remember that the closing balance here, the close is a year ended. So the closing balance of 2006 becomes the opening over here, which will also be what? The 51. That's why you're having 51 over here. And then we have year ended. So what will be your retained earnings? Year ended in 2007. It was previously 42. So now remember that this was also incurred in 2007. So we have to change this value to what? 52. Now we have liabilities in the question. Liability in the question. So this was the 1,000 and then 1,000. Now let's sum them out to see if you get the same 1,203. Yes, you get 1,203, and then here you get $1,151. So our account has balanced. So this is how you should what? Treat a change in accounting policy retrospectively. So remember that the actual change in the policy was occurring in 2007 ending, but because the entity or the question has prescribed that the earliest period for which this change must be applied is what? 1st January 2006. We have to go back and adjust the retained earnings of these two periods to show a retrospective what? Accounting treatment in the change in what? In the policy. Remember that if retrospective treatment of a change in policy is impractical, then we go or we treat it from the day the change in policy has occurred into the future. So in this case, if going back was impossible, we would have started the changes from 2007 into what? Into the future. So that is it for everything about how to select an accounting policy, how a change in accounting policy is supposed to be what? Accounted for, that is retrospectively, and then the guidance you are supposed to use to know that there's a change in accounting policy. So we want to now move to estimates. So as established earlier on, estimates are adjustments made to the carried amount of an asset or liability, which is as a result of a new information or a new development. We see that an item is an estimate if that item cannot be measured with what? A precision, or it comes with a level of what? An uncertainty. Many a times when entities are preparing their financial statement, they make several suggestions, or they make several estimates. For instance, estimate our provision of bad debt, estimate our provision of depreciation, estimate about the valuation of inventory, estimate about the useful life of the assets, and so many estimates in there. So there is a need to account for them if there is a change in what in an estimate. So there's a need to account for this estimate when there is a need that there is a change in what in an estimate. Now, do not confuse yourself with estimate and policy over here. Remember that with policy, there must be a change in the presentation, there must be a change in the recognition, and there must be a change in the measurement. That will only warrant what? Will only warrant, a change in the policy. When it comes to estimate, the only change here is just about what? A new information that is available, or a new development that is available, that there's a need for what? To change an estimate from one estimate to the other. Now, if you take depreciation of a non-current asset, if you want to look at how the asset should be valued, either you use the cost model or the revaluation model, then that will fall under what? Under policy, because there is a change in the measurement. But if you want to know whether you should use the reducing balance method or you should use the straight line method, that is just an estimate. Whether you want to use the reducing balance is subjective in nature. So that is what that will be under estimate. But if it were to be the revaluation method or the cost model, then that will fall under what? The change in policy. Again, if you look at investment property, whether you want to value it using the fair value model or the cost model, then that will fall under what? A change in policy. So when we talk about changing estimate, is basically a change in a change that arises as a result of a new information that is available, and this change only affects things that are what? Items that are what? Subjective in nature. Let's look at a practical example of a change in an estimate. Assuming you acquire an asset which costs $10,000 with a useful life of 10 years, and then at the end of year 3, so third year, there's a change because of an issue with the asset. There's a change in the useful life from 10 years to 6 years. So now assets will no longer have 10 years, but it will have 6 years. And this new information has become available at the end of what? 6 years. Now the question is, anytime there is a change in estimate, what do you do? It has to be what? Apply prospectively from the day the new information has become available to into the future periods. We don't change, or we don't account for change in estimate retrospectively, but we apply for a change in that estimate prospectively from the day the information or the new development or there's a status change of that particular item has become available, and we do that from that particular time into the future periods. So in this case, the information has become available in the third year. So now let's determine the carried amount of the asset in the third year. Now the annual depreciation is going to be 1,000 multiplied by 3 years will give us $3,000 in this case. So the carried amount is obviously going to be 7,000. So our annual depreciation from the time this information becomes available will now be the 7,000 divided by 6 minus 3, because they said 2. They didn't say the remaining useful life is 3 years or 6 years. They said 6 years. So this is the new year. Instead of the 10, we will now replace it with what? The 6. And we have already used 3 years out of it. So we have to deduct the 3 from it before we divide it right here, and we'll get $23,333,000. So this is how to account for it. A change in an estimate. It needs to be done, or it needs to be accounted for prospectively from the day the information becomes available into the foreseeable future. Finally, we want to look at errors and then look at how to account for errors. So earlier we said that errors are omissions from or misstatements in the financial statement, and this is, we call it an error because you have the right, the reliable and the relevant information to be used, but you didn't use it, or you didn't make use of them before the financial statements were authorized. So if that happened, then we say they are what? They are errors. Now errors comes in different forms. We have what we call misstatements or omissions. We also have what you call mistakes in applying the standard. We also have fraudulent activities, or we have mistakes. All these warrant towards to errors. Anytime there is an error in this financial statement, these errors need to be corrected retrospectively. When accounting for errors must be done retrospectively, just as you do for the policy, the same way you are supposed to effect the changes retrospectively. That means if you are, like I said earlier on, if you are in 2022 and then the error was incurred from 2018, they have to go to 2018 and then effect that error as if there was no error incurred. So retrospective treatment of errors is also important here. But once again, remember that if the information is available cannot aid you in applying or correcting the errors retrospectively, then you move on to correct the errors prospectively. So let's take this question to establish an understanding about how to effect errors retrospectively. Remember what is an error, and then the things that gives rise to error. Sometimes it's a mistake or omissions or misstatements. Sometimes too it is errors we make in applying because we don't have the requisite knowledge in applying a particular standard. We make errors. Sometimes it's a deliberate error, that is a fraudulent activity on the part of management. All this leads to what? Errors. And therefore remember that each corrections must be corrected retrospectively. So let's take this question. Remember the questions, the question will have their link in the video description, so you can get access to it so that you follow the solution. Let's look at our first question. So we are saying that during 2011, a company discovered that certain items had been included in inventory at the 31st December 2010. So in 2010, they realized that certain items have been included in the inventory as at 31st December 2010. And these items are 2.5 million in the question. And it has valued at 2.5 million, but they had in fact been sold before the year end. So this is the year-end inventory. So this is the closing inventory, and then this closing inventory had actually been sold, but we are accounted for it as what? As a closing inventory. That means it formed part of our cost of sale. But this is only discovered in 2011, but this was actually done in 2010. Now let's look at it. We were given the original sales value, the cost of sale value for 2010 and 2011. The question as you have, we have the gross profit given to us, we have the tax, and we have the non-profit, and again we have the retained profit or the retained earnings. So the retained earning in the question was retained earnings was 11,000, or that was 11.2 million. 11.2 million, and we were told that the cost of goods sold in 2011 includes the 2.5 million error in the opening inventory. Now show the statement of profit or loss with comparative figures and the retained earnings for each year. Disclosure of the comprehensive income is not required. Assume that the adjustment will have no effect on the tax charge. So this new adjustment will have no effect on what? The tax charge, as we have been rightly informed in the question. Now let's see how you go about this. Remember that this question actually gave us the cost of sale, and then this item too is a cost of sale item, so therefore the corrections can be done in the cost of sale. So to better understand this, let's start by this way. Let's have our 2011 year, and then let's have our 2010 over here. This is the beginning and this is the second year. So let's have it. It's in the dollar and it's in, let's put our 3 zeros at the top so that we can spend 3 zeros. So 3 zeros at the top here. Alright, so we have our sales. This sales figure is not affected in the question. They didn't tell us anything about the sales figure. The issue is about the cost of sale. So the sales figure was 52,100 in 2011, and the 48,300 over here. Now the original cost of sale in the question was 33,500 and that was in 2011, and then 30,200, that was in 2010. These are the original cost of sales in the question. Now, this is cost of sale. Under normal circumstances, I can go ahead and tell you we'll deduct or we'll let this, but it will not establish understanding. Now let's break this cost of sale into each component part. So first, remember that it is your opening inventory, and then we add our purchases. So we open inventory, then we add purchases to get our cost of goods available for sale. That is the COGAS, cost of goods available for sale. Then we less closing inventory over here. We less, so whatever we less, then we get our cost of sale. All right, so we do this to get cost of sales. Now, the information provided in the question didn't give us our opening inventory, it didn't give us our purchases, it didn't even give us our closing inventory figure, but we were given the cost of what sale. But how do we get this cost of sale? It was through this process that we had this cost of sale. Now, there was an item which was included in the cost of sale, which was the 2.5 million, which was not supposed to be less, but it was less. So what has it done to this cost of sale over here? It has reduced this cost of sale, which is the 2010 cost of sale, because it was the error was incurred in 2010. So it has reduced this cost of sale over here. That means it has increased the profit in 2010 because we have reduced our cost of our sale. So therefore, in 2010, we are supposed to add back. We have to add back the error committed because this was overstatement. It was not supposed to be there, but it was there. So in cost of sale, so in 2011, sorry, that was 2010, we are supposed to take the 30,200 plus the 2,500. That will give us our cost of sale. So it will not be this one, it will be the addition of this plus this, and this is going to give us 32,700. So I hope you are following. So remember why we are adding it. We are adding it because here the value was taken from something to get the cost of sale over here. So it has been taken. So we have to add it back. That's in the 2010. But this value became an opening balance in 2011. And opening balance, what do we do? It was added over here. So we have to what? Less. It was added. So when we come to the 2011 cost of sale, is going to be the 33,500 minus the 2,500. This is going to give us 31,000. Sorry, 31,000. That is going to be our cost of sale over here. So we less this from this one to get our gross profit over here. So gross profit. So if you do this correctly, you are going to get 21,000 over here, 21,100. Yes, because it was 52,100, and the second one we are going to get 15,600. We said the tax was not affected over here, so we have our tax over here, and then tax was 4,600 in the question, and then 4,300 in the question. So here our net profit in this case. Our net profit in this case is going to be 16,500, and then our 2010 profit is going to be 13,300. Remember that previously in the question the net profit was higher and this place was lesser, but because of these corrections and adjustments we have done, this has reduced this profit. So it has reduced this profit and has increased this profit from the question. So please, this is how you deal with what errors when they fall you. But we are left with how to get the retained earnings. So let's quickly do this one over here. How to get a retained earnings figure over here. We were told that the open retained earnings in 2010 was 11.2. So still is our dollar sign with the 3 zeros over here. So the opening, so we are looking at retained earnings. Retained earnings. This is also 3 zeros. Now the opening inventory 2010 was 11,200, and then the closing, sorry, the year, during the year, the profit was, so profit for the period was 11,300. So if you add this, you get your closing retained earnings. So opening retained earnings. So here is going to give us 22,500. Now you know that closing year becomes the opening 2011, so 22,500, and then now we add the profit of 2011 to it, which is 16,500. And this is going to give us 39,000 over here. So this is how to go with the retained earnings. There's another way you can deal with this. Either we take the retained earnings which was given to us in the question, and then add the old profit to it. So if you add the old profit to it, I think the old profit was 14,800. Sorry, 13,800. The old profit, not this one, it was 14,000. The question it was 13,800. If you add it to this one, you are going to get 25,000. Then you less the error from it was 2,500. You end up getting this 22,500. So either you go by this approach or you go by this simple approach to establish your retained earnings. So this is how you account for errors. You go back and treat it as if the error never occurred. So you'll take a second example where the tax will apply to the error, and you see how you treat that particular one as well. So RONAS Limited or PLC is preparing its financial statement for 2018. So 2018, and the draft statement of changes in equity is as follows. So in the question, the question will be in the video description. So we have it in this form. So let me just write the question here. We have what we call the share capital from the question. We have what we call capital reserve. This from the question. And then we have retained earnings over here. Retained earnings over here. Alright. So we have the balance for 2000 so that was 31st December 2016. Over here we have this place with 500, here 500, and then the last one is 90. And then we have profit for the year. So profit for the year will be profit for 20. It's not in the question, but you should know that the profit is going to be for 2017 because this was for 2016, the year end. So the profit for 2017 was 150, and this is supposed to be under retained earnings 150. And then we were given the balance at the end as at 31st December 2017. So this will give us, this will be 500 because this will be dash. This will also be 500, and this will be this plus this will give us 240. Now we were given the dividends. So we're given dividends in the question. And this dividends was 100. It was taken over here. So the balance of 140 over here. And then a balance of 500 as well. And this place is also 500 over here. And then we were given the profit for the year. So profit. So remember that this profit is for 2018 because we are having the end value here. So the profit for the year here is going to be, we're given a question to be 385. So if you add the balances, you are going to get 525. This is 500, and this is also 500 over here. So you are going to get 525 over here, and you get 500 over here. Now let's look at what the question is saying. They said the question has discovered an error in its inventory valuation. Inventory was overstated by 70 at the end of 2018. At the end of 2018, inventory was overstated by $70,000. and then also by 60,000 that at the end of 2017 and at the end of 2018 it was overstated at this figure. And then the rate of tax was 30%. We were given rate of tax to be 30% on this particular error. Now, how do we effect this error? There is an overstatement of our inventory. Remember that the inventory here in 2017 at year end becomes the opening in 2018, and these are closing inventories. So it was less from what they were less from our. It was less from our cost of goods available for sale. What I presented earlier on, it was less from our cost of goods available for sale to get our cost of sale. So these values has reduced our cost of sale, therefore increasing what our profit. You see here we don't have cost of sale over here. We are not privy to cost of sale. We are privy to what profit. So we can only effect the changes on what on profit. So you have to see what these errors have done to your profit. So like I told you, we less this from our cost of goods available for sale to get our cost of sale. That means it has reduced our cost of sale, therefore increasing what our profit. So these figures need to be what need to be less because it has increased our profit. They need to be what to be less. But remember that this, which was 2017, will become an opening which was added, and therefore must and it has what it has reduced our profit, and therefore must be added back. This one over here. So now let's see how we go about this. So because of the nature of the board, let's do this somewhere. Let's manage and fix it over here. Okay, so let's have 2017 here and then 2018 over here. Now let's say the profit. So the profit for 2017 was 150, and then the profit for this one was 385. Remember, this is the only two figures that we can effect the changes on. So it was closing balances. So like I said earlier on, it has reduced it has increased our profit because it has reduced the cost of sale. So here in 2017, which was 70, which was 60, must be less. So 60, you have to less the 60 from this and less the 70 from this one. But remember that this 60 will become an opening over here. So let's look at the difference over here. So the difference here, this is going to be 60%, sorry, 60 in bracket, and this is going to be 10 in bracket. We apply the tax on it. If you apply the tax on this one, this is going to give us 3, 30% on this is going to give us 3, and 30% of this is going to give us 8. So at the end, we are going to have the effect on this to be 7, and the effect on this to be 42, all in bracket. Now this is what we are going to less from our respective profit to get the new profit that we're supposed to be used. The reason why I don't want to clean this, that is the question. So what we are supposed to do here is just to change these two profit figures by these correct figures you'll get over here. So 7 from 385 is going to give us 378, and then 42 from 150 is going to get 108. So this should be the correct profit we should have accounted for. So here I'll change this profit here to 378 and change this profit here to 104. Therefore all these values will change. So here will be 194, and then here will be 94, and this place will change. This place will still be the same, over here. All right, so if you add 94 plus 378, that's going to give us 472. 408, 108 over here. So it's 108 over here. So this is going to give us 198, not 194. So this is going to give us 198 over here. So we add it to this, we are going to get 476 over here. So 476 over here. So this is how to correct the errors. Remember that this tax applied, and the tax was supposed to reduce these figures. The tax has actually, because of less profit in one of the case, because we have reduced our profit, the tax has also what reduced, and therefore must be added back. That is why you can see this positive tax over here, but these are negative figures. That's why the effect gives are this one, and we take it from our profit to get the actual profit we are supposed to end for the period. So This is basically how to go about the errors and how to retrospectively correct them. So this brings us to the end of our lesson, but don't forget about disclosure. You look at the changes in the policy, the new name for the policy. You look at the time it was changed, how to, if the information that was available to retrospectively carry out the changes, and all those information that are relevant that the end users will need it for their decision making purposes should be disclosed to the notes to the financial statement. Thank you for always being part of the learning family. If you have any question, do not hesitate to leave it at the comment section. Thank you.